Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. This week on Wealth Track, the alternative investment universe. We explore the world beyond stocks and bonds with great investor John Hathaway, manager of the Tocqueville Gold Fund, and investment advisor Phil Demuth, co-author of the Little Book of Alternative Investments. How far out should your portfolio go? We'll find out next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Did you know you can take Wealth Track with you? You can watch full episodes, you can watch the highlights, or read the newsletters, whenever, wherever. Let me show you how. In your web browser, type in m.wealthtrack.com. That's it. So join Wealth Track whenever and wherever you can. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This week we are going to explore alternative investments, what they are, what role they play in your portfolio, and which types you should own, if any. One of today's guests, Phil Demuth, who has co-authored a terrific primer on the subject called The Little Book of Alternative Investments, Reaping Rewards by Daring to be Different, jokingly calls them alternatives to all those other investments that lose money, like stocks and bonds and real estate. Alternative investments are supposed to zig when traditional investments like stocks zag. That is known as having a negative or low correlation, or they are supposed to move entirely independently. When they do, they offset the downside risk found in portfolios when stock markets decline. But they also hold back the portfolio on the upside when stock markets rally, which is why most advisors like Demuth believe they should play a peripheral, not central role in most individuals' portfolios. What kinds of investments move to a different alternative drummer? During the financial crisis of 2008 and 2009, cash, U.S. Treasury securities, and managed futures, which invest in futures contracts for everything from commodities to currencies to interest rates, were among the investments that rose when other investments fell. And over a longer time period, during the so-called lost decade from 1999 to 2009, when the stock market delivered a measly average annualized return of negative 1%, investments such as real estate investment trusts known as REITs, emerging market local currencies, Treasury inflation-protected securities, or TIPS, long-maturity Treasury bonds, and commodities clocked in average annualized returns ranging from 10% to 7%. As several Wealth Track guests have told us in the past, if investors had broadly diversified their portfolios among many different asset classes, including some alternative investments, the lost decade would have been a found money-making one. Then there were the other types of alternative investments, which until recently were only available to the super rich or institutional investors. Chief among them are hedge funds. Two of what we call our next generation great investor guests, Cliff Asness of AQR Capital Management and MIT professor Andy Lowe of Alpha Simplex Group, offer hedge fund strategies in mutual fund form for the little guy. Hedge funds are an area one of our guests has done quite a bit of research on. He is Phil Demuth, Managing Director of Conservative Wealth Management, an investment advisory firm for high net worth individuals, institutions, and foundations. And as I mentioned earlier, he is the co-author of a recent book about alternative investments. It is the 7th book he has co-written with Ben Stein. Yes, the Ben Stein of economics, entertainment, and commentary fame, and a former Wealth Track guest. Phil is joined by a great investor who now specializes in one of the oldest alternative investments around, gold, which for centuries has been the investment and currency of choice for the world. He is John Hathaway, portfolio manager of the 4-star rated Tocqueville Gold Fund, which he founded as a contrarian move in 1998 near the height of the tech stock bubble. Tocqueville Gold has beaten the market and vast majority of its peers over the last 3, 5, and 10-year periods. I began the interview by asking Phil Demuth what role alternative investment should play in our portfolios.
Well, Consuelo, the first thing I want to say is thank you for bringing us Wealth Track. The show is a national treasure, and speaking of alternatives, it is the only alternative show discussing long-term investments for people. So it's made us all richer.
I did not pay him to say this, John, but you know what? I might later.
You'll be back.
Exactly.
Alternatives really came to the fore for many investors during a year like 2008, when the stock market was down like 37%. And we found that not only were all of our normally what we thought of alternative investments were down, real estate, commodities, emerging markets, foreign markets, everything was down at the same time. But then we also saw that because the stock market's tied to the business cycle, that everything in our lives is down at the same time. You know, we're worried about, can we keep our jobs? Can our spouse keep her job? So everything sort of starts circling the drain at once. So this causes us to sort of sharpen our focus a little bit and look for things that are not correlated, that don't go down when everything else goes down. Hence the search for alternative investments, and hence the book.
John Hathaway, it's so interesting, as we were just talking off camera, is that in 1998 you founded the Tocqueville Gold Fund.
Right.
And you at Tocqueville, which is a contrarian shop, basically we're sitting around the table seeing all these tech stocks going up, you know, no earnings, ridiculous prices and everything else. And so you said it was just a casual conversation of, you know, where in the world can we invest? And lo and behold, you decided to start a gold fund?
It was like Rodney Dangerfield. I mean, it was just a joke. And we didn't see how we could lose money. We didn't know that we would make money, but we just knew that it was so disparaged. And it was a high quality asset that had a history of being uncorrelated with other assets. And so that's all we knew. I mean, basically, it's way out of favor, and so, you know, we boned up on gold, and here we are today.
The question that a lot of investors are asking themselves is, gee, is it too late to get into gold? Is the best behind us? And your answer to that is?
Well, the possibility of gold going from 250 to 1700, or whatever that works out to, 6-7 times. For that to happen again, I think the world we live in would be very different than it is today.
Not good.
Probably not. I wouldn't rule it out. But I do think that we're in an environment where gold can still attract money. And the reason for that is that real interest rates are negative. So if you have a lot of liquid assets and you can't get a rate of return in a risk-free asset like a 90-day treasury, you have to think of other things. And so gold is one of a number of things that you certainly legitimately can think about. And as long as those conditions prevail, you're at the margin, I think, going to see capital migrating into a safe haven, which is what gold basically is. You shouldn't buy gold to make money. You should basically buy it to protect capital. But what we do is invest in gold mining equities, which are riskier assets and benefit from the macro condition that I just described.
Phil, let me ask you, number one, what is your view of gold and gold mining stocks and the role that they should play in an individual's portfolio and your clients' portfolios?
Well, Ben Stein and I went on a pilgrimage to Omaha to visit our guru, Warren Buffett. And we said, Yoda, gold, what do you think? And he said, I'm showing you 2 doors. Behind one door is a cube of gold, 67 feet on one side. All the gold in the world. Behind the other door is something of equal value, 7 Exxon Mobils, all the farmland in the United States, and $1 trillion of walking around money. Take your choice. Now, this was
so that's gold or Berkshire is basically what.
I just can't be silent when I hear this, and with no disrespect, had Buffett invested in gold, or had an investor had equal shares of Berkshire Hathaway, and a good gold fund, which will remain nameless, they would have done a lot better. And that's not always going to be the case, and who knows what the next 10 years look like. But gold has a time and a place, and had Warren invested in gold 10 years ago, or had his investors invested in gold alongside of Berkshire Hathaway, they'd be a little happier today than they probably are right now.
It was a hypothetical. He wasn't really offering us one or the other. He was saying, which one would you want to take? So his point, I think, is that gold and commodities in general are not earning assets. You're basically buying them on the hope that they're going to be worth more when you go to sell them than they are now. So the concern is, after a big run-up, are we going to still see another big run-up? If it's gone up a lot, it can go down a lot, and there's not an earning asset beneath it, so to speak, to buoy the price.
So that is the standard argument, except I would say that Mr. Buffett gave you a false choice, because the point is alternative investments, it's not an all or nothing.
It's not either or.
And you feel that way too, because I read your book,
Yes.
and the point is that they have a distinct role in a portfolio. So first of all, why don't you answer him, and then I'm going to ask you about that distinct role and,
Sure.
and which alternative investments fulfill those roles.
Sure. I mean, for one thing, gold should coexist with other investment strategies, and it is essentially a monetary asset, and yes, it doesn't earn anything, but neither does money, neither does cash.
Right now.
Right now, this has infinite duration. It has no counterparty risk. In a world of the MF globals today, counterparty risk is a big issue. It is something which you ought to have as a diversifier. And the price is going to be a function not so much of speculators getting into it and trying to make a killing. It's going to be really more of a function of bad public policy, which we seem to have in spades today. And with negative real interest rates, which give you no incentive to save almost in any government instrument today, gold gets a green light.
So let me ask you, Phil, and quote you, because you said that basically that alternative investments, should offer returns different than stocks and bonds, and quote, enable you to control and reduce portfolio volatility and risk, and they should be transparent and liquid. So which alternative investments meet those criteria?
Since about 2008, again, what we've found is that a number of hedge fund strategies have started to be co-opted by people that run mutual funds, and they've been packaged in a mutual fund format. And this is very interesting to ordinary retail investors, because a mutual fund has a lot of liquidity and transparency in a way that a hedge fund doesn't. Originally it was thought, people think about hedge funds and it's either some guys shorted the Bank of England and made $1 billion, or it's somebody else being hauled off to jail. But the average hedge fund manager is actually a lot more subdued than that. They've mastered some little niche of the market, and to us it looks like they're pulling a rabbit out of an empty hat and generating returns. But actually, if you go backstage, you find there's actually a rabbit in the hat to begin with. And this is the secret that the mutual fund companies have learned. What are these little niches that these guys are doing? And they've been able to package them. And so in that respect, I think the mutual funds provide a much better framework for the retail investor to get involved.
So, if mutual funds are just getting into this business, they're new at this business. So why should I trust them to do alternative investments? Because this is new territory for them, because they just want to make money and get me to invest with them.
Well, of course. But in some cases, it's the same people who run hedge funds who are also seeing another opportunity, another distribution channel.
Right.
So they're opening up the mutual funds at the same time.
So there are some legitimate hedge fund managers. And we've had them on WealthTrack. Cliff Asness,
Yes.
Andy Lowe, for instance.
Yep.
They have a history in this business, and they're now offering it to the general public.
Exactly.
But for me as an individual investor, which strategies should I be looking at? And again, what role do these mutual funds / hedge funds have in my portfolio? What should I expect them to do for me?
This would be a satellite holding. They would be sort of on the side with your stocks and bonds. And the point of it would be to lower the volatility of the portfolio. Hedge funds have returns and risks that usually fall about halfway between the stock market and the bond market. So it's not something that's going to sex up your portfolio. It's actually going to just sort of dampen it down a little bit. So that's what we're wanting it to do.
Okay, and you think that hedge funds can fulfill that role? That
for a ultra high net worth investor who has $25 million, they typically have about 6% of their assets in hedge funds. But for a retail investor, they can get some of the same kind of exposure by using these new hedge funds that have been appropriated by the mutual fund industry.
And again, the role of gold in the portfolio, even what John was talking about, which it is, it's considered an insurance policy against extreme outcomes, as Peter Bernstein has said on our show. So even as an insurance policy, do you not think that gold has a role in an individual's portfolio, and is it a matter of price at these levels, or just in general principle?
Well, we like commodities in general.
You do?
As part of a portfolio. So, and gold would, of course, be part of that allocation. And in terms of investing in gold specifically, I'm a person who wishes he invested with John's fund in 1998.
But you wouldn't today?
At this price today, well, I suppose I have a small amount of gold, but I'm not like jumping in with both feet and saying, let's buy lots and lots of gold. It's like buying insurance when a hurricane is ready to hit Miami. It's like, we already see the hurricane coming. Everybody sees it. We're aware of this. The best time to buy insurance is when there's just a calm ocean.
Well, the good news is that John's fund doesn't just invest in gold bullion, because you're investing in gold mining stocks.
We own the equities of mining companies, which
primarily, like the vast majority of the Tocqueville Gold Fund is, right.
This preponderant holding of what we have is mining companies.
Right.
And, I think, as I said earlier, the possibility that gold has the same return of something like 13-14% a year that it's had for the past 10 years, that would lead to a different world than we live in. But I think that if I'm a thinking investor, I would want to at least protect my capital to some extent by having some exposure in case that happens. And if it doesn't, if things turn out better, then I'll be much happier with the 90% or so that I have in other assets, including plain vanilla stocks and some of the things that Phil's talking about. And the idea that the price is high, I think, is really not the view that I would take.
And so the view that you would take
is that money has been debased. Our banking system has been debased. The dollar may well be on its final round of being an international reserve currency. These are macro developments that I watch very carefully, and I don't expect Phil necessarily to have a point of view on that, and you don't need to. But if you put money into gold today, you do it because you're looking at what's going on in Europe, you're looking at the policies of the Federal Reserve, you're looking at the likelihood that we'll have low or negative real rates for many, many years to come. And of course, there's the wild card of what else could go on. And if you buy a mining stock today, you're getting a 2 or 3% dividend yield. You're paying less than 10 times cash flow, roughly 10 or 11 times current earnings. And you get basically a free call on the future gold price. And if gold goes up, there should be a leveraged return to at gold equity.
Which is why, about 80% plus of your fund is invested in gold mining stocks,
exactly.
Right? Which have actually vastly underperformed gold bullion.
This year, they've been quite surprisingly laggards. Gold is up roughly 20% year to date. And if you had told me at the beginning of the year that gold stocks would be flat to down, I would have said that can't be.
So why do you think it is?
Well, it's because I think because gold has gone up so much, particularly in August over the debt ceiling debates, it got basically overcooked. It was overbought and all of that. Now it's settled back and sentiment is back to very bearish levels, which is constructive as a contrarian. But I think the gold stocks had to deal with that adjustment. But now that we have some time and gold has settled down, and maybe in a range for a little bit of a while, it's possible to say, yeah, these companies can earn a lot of money based at $1,600, $1,700 gold. So,
Phil, I'm really interested in the concept of mitigating portfolio risk and really softening it as far as alternative investments. And you kind of said that they're ancillary investments that you have. So you still think that even with the kind of market volatility we have seen recently, which has been extraordinarily high, that we should still stick with our kind of core holdings of stocks, bonds, and cash, and just have the peripheral investments in alternative investments?
It depends on how knowledgeable you are about it, because we don't want people investing beyond their headlights.
Right.
So the strategies can be complicated. To the extent to which they understand them, they can be comfortable moving into this arena. But for the average person, they'll have a smaller understanding, so a smaller allocation might be warranted, perhaps 5 or 6%. As they get comfortable, they might want to move into an institutional range and have 10 to 25% of their assets there. So that's kind of, I would say, start small, do your homework, and then move up as you become comfortable.
Let's say I'm not that knowledgeable, but guess what? I come to you and I say, I want you to help me manage my portfolio and my financial
Bless
life.
you.
When a client comes to you, because you do know, you just wrote a book about it with Ben Stein. So when they come to you, so what's the little alternative investment portfolio that you put together for someone? I mean, what should it have in it?
I do several things. One of the funds that I'm interested in is a managed futures fund. This is a strategy that just follows about 100 different futures markets, commodities, stocks, currencies, bonds, and it's a trend-following system. They just have, each manager has their own little trend-following. They're betting on things going up, betting on things going down, rebalancing. And this is a strategy that tends to work, believe it or not. And so,
right, so managed futures have actually been one of those non-correlated assets that worked extremely well during the financial meltdown.
Right, they were up about 18% in 2008, which was a great time to have something be up to 18%.
Right.
So a friend in times of need is a good friend. So this is a good strategy because it can make money in up or down markets.
Managed futures, right.
Another thing that I think is good is just to use a multi-strategy fund, because there you have the manager, him or herself, looking over a field of 10 or 30 or 60 sub-strategies. And he's saying, what's working right now? And he can allocate the capital to whatever is doing the best at any given time, more so than I can following 60 different funds and trying to allocate. He can do it in real time better than I can. So I think that's another good way to go.
And John, one of the things that we had also talked about off camera was the fact that it's not that you're like a gold bug, and you don't think that everyone should own gold all of the time. And
No.
in fact, that there are times when one shouldn't own gold. We're just not in one of them now. So when might you decide, we're out of this market?
What's the bell ringing? Political sea change of some sort that would create renewed respectability for paper currency. That's what it's all about.
Right. So one investment for a long-term diversified portfolio that all of us should own some of. Is there a particular, fund that we all should maybe own some of that's invest in alternative investments? Or
Yes, there's a fellow named Andrew Lo, professor at MIT, head of their Department of Financial Engineering. He's a smart guy.
We've had him on Wealth Track. Very smart guy.
He runs a hedge fund that's a multi-strategy mutual fund hedge fund for ASG Natixis. And I think this is a good fund. It's open to retail investors. And what I love about it is that he actively manages the volatility of the fund. So if it gets too wild, he can water it down with cash. And he also keeps his eye on the stock market. And so if it starts correlating with the stock market, he shorts out that component. So it's a true hedge. You're not paying a lot of money for a supposed hedge fund that just is another market fund, basically.
And Andy Lo is a very smart guy, and he also feels that the volatility in the market is here to stay. So that's a feature that we've got to live with. So, and John, in the gold sphere, is there? I know we can't recommend our own funds. Mm-hmm. So is there a particular, if I wanted to
Sure.
own one?
Yeah, a generic go-to name, high quality company, well managed, good assets would be Newmont Mining. It's got valuation, it's got yield. They've tied their dividend yield to the gold price. If it goes up, the dividend goes up.
If it goes down,
dividend goes down. But it gives an investor dynamic exposure to the gold price, which is what many people want. And I think, personally, I don't think volatility is something that you should run away from. I think volatility is not the same thing as real risk. Real risk is when an investment fails. How it's priced on any given day is a function of market sentiment and a lot of things that are very ephemeral. So, I think for somebody who has a long-term view that having some protection against currency debasement in the form of an equity, I would say Newmont Mining.
All right. Terrific. Thank you both so much for joining us on Wealth
Pleasure.
Track. I really
Great to be
appreciate
here.
it.
Thank you.
John Hathaway from the Tocqueville Gold Fund and Phil Demuth. I'm getting 2 credits here. The Little Book of Alternative Investments, which is a terrific primer on alternative
Thank
investments,
you.
incidentally, and also with conservative wealth management. Thank you so much for being here.
Pleasure.
Thanks a lot.
At the end of every Wealth Track, we make a recommendation to help you build and protect your wealth over the long term. This week's action point is read Phil Demuth and Ben Stein's book, The Little Book of Alternative Investments, Reaping Rewards by Daring to be Different. Similar to all 7 of the Demuth-Stein personal finance books, this is chock full of easy-to-digest information, useful advice, specific fund recommendations, and it is a hoot and a holler to read, not a dull page in it. And it will tell you just about everything you need to know about these essential alternative investment portfolio diversifiers. And next week, we are delighted to welcome back great investor Don Yachman, founder and portfolio manager of the 5-star Yachman Fund, which has been in the top 1% of its category for the past 15 years. Yachman was a finalist for Morningstar's 2011 Domestic Stock Fund Manager of the Year Award. And that concludes this edition of Wealth Track. Thank you so much for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.